All right, welcome everybody for another video session here. Let's go ahead and talk about a simple way to trade. As many of you recall, one of my favorite things to do is to keep my charts clean. Looking at price action, looking at volume, maybe adding one or two indicators, I think is probably just enough. When you complicate things, things become a little bit more difficult. And also, if you're relying on indicators too much, they're either lagging, meaning that they are not in real time, or they're just not giving you the correct signal or conflicting signals. Or even when you have indicators that line up together and give you the same signal, price and volume really dictate real time action and really end up truly becoming the ultimate best indicators. But that doesn't mean we can't put any indicators on our screen. So let's talk about two of them right now that I think are very, very helpful. You can use these on any time frames. I like to use the moving average. And in particular, I like to use the exponential moving average because it gives you a little bit more of an accurate average reading of price action for a particular set of bars or set of minutes going back, depending on whatever it is that you like to indicate. So, for example, let's just say you have an indicator, a 9 moving average, and you set it to look back to the most recent 100 or 50 bars. It'll give you a line, and in this case, we have the 9-day moving average here in yellow. This is giving us the average close price over the last 100 bars or last 100 days, whatever it is that you set it to. And then, of course, we have the 200 moving average, which is this green line here. And that tells us, okay, this is where the price has closed over the last 200 bars or 200 days. So the moving averages are based on days, but you can alter the time frame of the look back period within the actual indicator itself. So what I like to do, again, I like to keep things very simple. So I just keep it 9 moving average. I don't touch the amount of time frame that it goes back. I just like a 9-day average close and then a 200-day average close, and that's it. And the particular strategy or my edge is specifically going to be whenever the 9 or the 200 cross. So at any time there's a cross, I'm looking for opportunities. So let's just take a look here. Here we have NVIDIA on this chart. Now, market opens within the first 15 minutes or so. I typically don't trade just because there's a lot of volatility. The market has really selected a direction just yet, so we're just kind of waiting and monitoring. We haven't taken a bias yet, whether long or short. We're just kind of waiting and watching. Now, once this second cross happens here, so we see the first cross happens here, then it kind of consolidates. The second cross happens here. I'm essentially just kind of waiting for a retest, right? And I'm just kind of riding that 9 EMA. So somewhere around here is where I'd like to see, either volume or price uptake, and then I'm probably going to get in right here and kind of ride this wave and take profits on the way up. If I see the price close below the EMA, that could be an indication of a direction trend change. Or if it drops quickly, sometimes it drops to the 200, bounces back. So that's another way to kind of take profits. But you really want to be kind of scaling out as you're going in and take your profits always. So let's just look at another example. That was kind of a long example. Let's look at Tesla. Kind of choppy throughout the day, but once it broke and it kind of came and retested here, we started seeing this kind of downward trend. Let's just look at another day here. Let's just pick any random day. Okay, so here's a day where it popped up in the morning and then it kept coming back. And we're looking at the 3-minute chart, by the way. It popped back down and then at some point it crossed. But again, I don't want to jump in right at the cross. I want to wait for the retest. So I see it retested here and then it drops down. So I'm in this trade with a stop loss of either the 9 EMA or the 200. Right, and then just kind of riding it down, and then it kind of consolidated for the rest of the day. But you're kind of taking profits as it continues to dip. So it really is a very, very beneficial tool for trend days. So this really isn't going to work too good on consolidation days where the market is just kind of bouncing around. Let's just take a look at SPY here. Um, I think it was yesterday. No, it was a